The Federal Reserve Act had become law in December 1913, but the 12 reserve banks were still being organized when Europe went to war. The full Federal Reserve Board was not sworn in until August 10, 1914, and the reserve banks did not open until November 16th. That timing matters. The institution designed to make American currency more flexible could not yet supply the system when cash demand surged. The Treasury Department and private clearinghouses therefore took the lead. The crisis of 1914 was not a test the new central bank failed. It was a crisis that arrived before the operating parts of the new central bank existed. As European war approached, European exchanges closed and investors turned to the open American market for liquidity. Economist William Silber estimates that foreigners owned more than $4 billion of American railroad stocks and bonds, including $3 billion held in Britain. Those securities could be sold quickly in New York. A foreign holder could sell an American bond, obtain dollars, and use the proceeds to acquire gold or foreign exchange. That made Wall Street more than a stock market. It was a door through which wartime demand for cash could pull gold out of the American banking system. Under the gold standard, international payment pressure could become a physical reserve loss. Silber dates the acute American crisis to July 27th, when sterling reached $4.92, about 4 cents above the gold export point, and gold shipments followed. The New York Clearinghouse reported that its member banks lost almost $44 million of reserves during the week before August 1st and stood $17 million below their required reserve level. The danger was mechanical. Security sales increased demand for sterling or gold. Gold exports reduced bank reserves, and falling reserves made banks less able to meet domestic withdrawals. Fear of that chain could produce the very cash demand bankers feared. Treasury Secretary William McAdoo asked the New York Stock Exchange to close on July 31st, and the exchange did so. The purpose was to obstruct the fastest route from foreign sales of American securities to demands for American gold. The exchange remained closed for stock trading through December 12th. Closing the market reduced immediate selling and gold demand, but it did not erase debts owed abroad or cash withdrawals at home. It bought time. That time only had value if officials and bankers could build other ways to supply money and settle payments before confidence broke. Closing the exchange also removed a source of bank liquidity. New York member banks could no longer liquidate call loans through the stock market in order to raise cash. McAdoo met New York Clearinghouse members on August 2nd, and the Clearinghouse authorized loan certificates the next day. These certificates let member banks settle balances with one another without transferring the same amount of cash. They could not be used to satisfy public withdrawals. The certificates did not solve every problem, but they reduced the amount of scarce legal money needed inside the clearing system while the exchange was shut. Congress had created another emergency tool in 1908. The Aldrich-Vreeland Act authorized as much as $500 million of additional currency backed by collateral beyond the United States bonds normally required for national banknotes. The Federal Reserve Act extended that authority to June 30, 1915. According to the Federal Deposit Insurance Corporation, the authority was used only once, during the Panic of 1914. The temporary law was still alive when the new central bank was not. That accident of timing gave the Treasury a legal path to turn bank assets into circulating notes. Congress amended the emergency currency rules on August 4th, allowing the Treasury Secretary to suspend the original $500 million ceiling. Banks could obtain notes by pledging municipal bonds directly or by placing other securities or commercial paper with a national currency association. This was not money without backing. Emergency currency collateral was subject to minimum discounts, and National Currency Association members were jointly liable for issuance. Yale's New Baygot database reports that participants issued $386 million in total, and that about $364 million was outstanding at the peak on October 24th. The notes gave banks a way to meet cash demand without dumping assets into a closed or distressed market. Emergency currency and clearinghouse certificates served different users. National banks had the clearest route to the federal emergency notes. State banks and trust companies largely lacked that access unless they accepted Federal Reserve membership requirements. Research summarized by Yale describes the clearinghouse certificates as a secondary but consequential source of liquidity, especially for those institutions. The result was a layered defense. Federal emergency notes could meet demands for circulating currency, while private certificates conserved cash and settlements among clearinghouse members. Neither layer repaired a bad asset or canceled a debt. Both layers changed how quickly institutions had to produce legal money. Liquidity measures could contain the run, but America also needed a way to earn the foreign payments it owed. McAdoo organized the Bureau of War Risk Insurance on September 3rd to promote exports of cotton and wheat. The mechanism was different from emergency currency. Selling goods abroad could bring in foreign payments, while issuing notes only changed how banks met domestic demand for cash. Export support did not settle every obligation immediately, and wartime shipping remained